Which companies are the best credit risks should rates rise or the economy slow? Here to tell us that is James Gellert from Rapid Ratings. Welcome, James.
Thank you very much.
It's good to have you here. First of all, tell me, how does Rapid Ratings differ from S&P, Moody's, or Fitch?
We differ in a few different ways. One, we're paid by subscribers to our service as opposed to the companies that we're rating. So we avoid all of the conflicts of interest of the so-called issuer-paid ratings agencies. We also rate based on having access to the financial statements of companies, so it's completely non-discretionary. We've got a very model-based system, and every quarter we're re-rating quarterly filers, so we're able to provide a dynamic rating on an ongoing basis as opposed to having the ratings that tend to be stale and flat for a very long period of time, partially due to the interaction that the big rating agencies have with management that are paying them to perform those ratings.
Well, those guys got into a whole lot of trouble. I don't want to get into that. I want to talk about the best credit risk right now.
Sure.
You say it's the entertainment industry, the leisure industry. Why is that?
We look at 31 different sectors on an ongoing basis, and we rate about 11,000 global public companies and thousands of private companies as well. What we're finding right now is that we've seen market increase in the leisure, entertainment, hospitality areas, and that really is at the top of the rank order of our sector list at the moment. One
company that you're watching is Six Flags. Whenever people look at Six Flags, they worry about gas prices. Gas prices are ticking higher. Will this hurt Six Flags' credit rating over the long term?
Well, one of the interesting things about our ratings is they're really a reflection on how well positioned a company is to withstand a shock. So we're looking at the efficiency with which a company is run, and Six Flags has had increasing efficiency as measured by the over 60 measures that we look at in 6 broad performance categories. So when we look at their ratings and the fact that they've had a double-digit increase in the financial health rating from Rapid Ratings over the last year, we see that they're really quite well positioned, and even an uptick in gas prices, which possibly could hurt a little bit at the gate, we think they're in pretty good stead despite that.
You also view Dennys as a grand slam. Sorry, I had to do it. Why do you like Dennys?
Dennys is also improving in its efficiency measures. Also has had a double-digit uptick in the last quarter and over the last year. And of the 6 performance categories that we look at, sales, performance, operating or profitability, working capital efficiency, cost structure efficiency, leveraging, debt service management, they've been improving in sales performance, in profitability, and in the capital structure, which is basically working capital efficiency and leveraging.
Now, you're not making a stock recommendation here. You're just saying that these companies, from a credit perspective, are good bets, right?
Yes, that's absolutely right. So we are not giving buy, hold, and sells. It happens that the companies that we rate lower do tend to perform better and tend to have less volatility, as evidenced by indexes that we've launched last year.
And on the flip side, which companies aren't doing so well right now when it comes to their balance sheets, the way you look at them?
Well, the lowest sectors that we have right now are forest products, which probably isn't a giant surprise, and they've been relatively low for a while, and the oil and gas producers.
Any names in particular we should watch?
Well, an interesting drop of 14 points over the last quarter in Boise. So there's an example. We've also had relatively steady, but also a little bit of a decrease in international paper.
All right. Thanks a lot, James.
Thank you for having me.
And thank you for watching The Street.